In this video, we're breaking down what's happening in the market, viewing the current landscape through the lens of gamma exposure, and discussing actionable strategies you can implement. While the market remains optimistic and the uptrend is still intact, we're seeing a massive extension from key moving averages and overbought conditions across multiple levels. To clarify what I mean by multiple levels, consider a scenario where the market has been falling for a long time and has moved well below key moving averages. At a certain point, all indicators will show oversold conditions. If one day the market reverses and starts rallying strongly, then an indicator like the RSI can very quickly move into overbought territory. But that would be a local overbought condition on a single level, because there is still a long way to go to reach the moving averages, or perhaps market breadth suggests that it is just beginning to turn. So such local overbought readings don't have much impact. But when several indicators start signaling overheating at the same time, those signals are considered stronger. But don't forget that the market has a unique characteristic. It can bounce sharply from oversold levels, but it can stay overbought for months. So this information should be seen not as a doomsday signal that everything should crash immediately, but rather as a signal that without tying ourselves to specific dates or targets, the market is currently at levels from which over the next couple of months we could see a correction develop. On shorter-term intervals, the weekly probability distribution curve places the immediate 1 sigma resistance level at 7,500 and support at 7,330. On Tuesday, the price reached this level, an upward bounce occurred from it, and now the price is approaching the resistance level. Now let's take a look at what's going on with gamma exposure. If on Monday you had OpenSPY in our app, the link to which is in the description below this video, and selected all expiration dates from Monday through Friday inclusive, you would have gotten a picture like this. Let's highlight all the key points. The largest clusters of negative and absolute gamma are at the 720 and 725 strikes. The gamma flip zone is right here. We also mark the 730 to 731 range. This is a positive gamma island and another large cluster of absolute gamma. The week started near the gamma flip zone. Total positive gamma significantly outweighed the negative, which meant that from a gamma exposure standpoint, the setup for the week actually looked quite bullish. Yes, the largest negative and absolute gamma values are located at the 720 and 725 strikes. But before we can even consider the price falling that far, it first needs to break through the 730 to 731 range, which is the nearest support level. This range consists of a positive gamma island, and furthermore, within that range there was a dense concentration of absolute gamma with relatively compressed negative gamma. This additionally indicated that a battle between the bulls and the bears would play out in this area. As the main resistance level and simultaneously an upside target, we could highlight the 750 strike because that is where the largest weekly positive gamma values are located. But the most interesting thing starts to happen when we add next week to the analysis of this week. Here we see that the 745 level is crucial, and it is precisely the main reason for the rally we are seeing right now. So in this case, it would be more accurate to say that this week the 750 level was not an upside target, but rather a resistance level after the price, figuratively speaking, traveled along the orbit of the 745 level. If we transfer all these levels to our usual chart, the picture becomes even clearer. Here is the main resistance level. The target level is at 745. The gamma flip zone runs right here. The largest negative and absolute gamma values are located at the 720 and 725 strikes. But as I said above, we would be unlikely to see the price fall that far this week because first it would need to break through the 730 to 731 range, which is the nearest support. By the end of Tuesday, the price had reached the nearest support level from which an impulsive upward bounce began, and today the price has reached the main targets. So if you want to see in advance what's happening behind the scenes of the market, the link to the app with all the necessary information is in the description below this video. Let's summarize. For the most part, the market hit its full potential this week. If we look at the gamma exposure profile for next week, the 745 level remains dominant. Keep in mind that the weekly gamma exposure profile is best viewed once the week has already begun. In other words, it's better to assess the market for next week on Monday because the picture will be more current. But in any case, the 745 level will be decisive, and as of now there are no levels above it that could compete with it or be seen as the next upside targets. This suggests that the market was potentially being pulled up to this level ahead of Trump's trip to China, and that this range represents the finish line in this powerful bull run. As for daily levels, today the main resistance is in the range of 7,500 to 7,510 and the main support is at the 7,400 level. but watching the resistance level is certainly more interesting. Now let's discuss the strategies that can be implemented. Since this week is coming to an end, we will be talking about trades expiring next Friday. Today we discussed that the market has reached a resistance level, there is strong overbought conditions, and from a gamma exposure perspective for next week we see no upside targets for the price. Therefore, it is best to avoid long positions right now and wait for a correction. If you decide to open neutral positions like an iron condor, try to make the range as wide as possible. Because if the condor is not wide enough, given the levels where the price is right now, it could move beyond the range in just one day and the position would immediately start showing a loss. So don't neglect safety, it's better to sacrifice some profit than to take on unnecessary risk. Another strategy that I like is the iron butterfly on SPY. The expiration date is set for next Friday, the center is placed at the 7:45 strike, and in the context of 5 lots, the position profile will look like this. The maximum loss will be approximately $1,200, and the maximum profit will be around $4,000. Keep in mind that this position is rarely held until expiration. Typically, it is held for a few days, and if on Tuesday, Wednesday, or Thursday the price is within this range, you can close it and lock in the profit. The idea behind this strategy is that the break-even points will be at some distance from the current price, and if the market does decide to rise next week while volatility declines, this position will still generate decent profit. Another strategy that I really like right now is the iron butterfly, also on SPY. The expiration date is set for next Friday, and here we see an example with a quantity of 5 lots, and you can see the strikes here. In this strategy, we shift the left wing a bit closer to the center of the structure, which creates a position profile like this. The main idea is that if the price declines in the coming days and volatility rises at the same time, it will slightly reduce the profitability of the strategy, but relative to the entry point we will immediately start seeing a profit even with a small decline. If closer to expiration the price is around 745, this position will generate maximum profit. And as in the previous example, we leave ourselves a little room in case the upward move continues a bit further. Another advantage is that even if the price rises above 750, this position will show only a minimal loss that can be locked in. As a more aggressive bet on a decline, you could open a calendar put spread on the SPX choosing the 7300 strikes with expiration next Friday. This position will be inexpensive, only $450. The break-even point is just 0.5% below the current price, and if by expiration the price falls to 7,300, this position will generate maximum profit. But even at the 7,350 or 7,300 level, the profit will still be very good. However, there is always the risk that after we open this position, the price doesn't fall, stays range-bound, or even rises. In that scenario, this strategy will start showing a loss. But the good news is that this strategy is very easy to hedge. We can do that using the iron butterfly on SPY that I mentioned earlier. If, for example, we simulate a situation where by next Wednesday the market rises by 0.5% and volatility declines, the loss on the calendar put spread would be approximately $250. But under the same conditions, a 0.5% rise in price and a decline in volatility, by next Wednesday the iron butterfly would generate a profit of $500 and those losses would be offset. You could also implement a more aggressive hedge and use an iron butterfly like this one. Let's simulate a couple of scenarios. If next Wednesday the market falls by 1%, the calendar put spread will generate a profit of $1,000. With the same market decline, the loss on the iron butterfly would be about $300, so together this combination would be in the green by roughly $700. If by Wednesday the price rises by 0.5%, the iron butterfly will show a profit of $340, and simultaneously, with a 0.5% rise in price and a decline in volatility, the loss on the calendar put spread would be approximately $300. If the price continues to rise, the iron butterfly will keep generating profit that offsets the loss on the calendar put spread, resulting in a very good combination. What I mean is that if the price rises, we lose nothing and the short position ends up being free. But if the price starts to fall, we will see very good profit. That's all for today. Good luck with your trading and see you next time.